2026, the market won't be chaotic. It would simply expose who's disciplined and who's emotional. So in this video, we're not guessing whether the price will go up or down. We're looking at what actually matters going into 2026, which is the conditions shaping the crypto and Forex markets, along with how traders should be thinking as the next cycle unfolds. Hi, I'm Justin from Vincero Investment Academy, and I've been trading for over a decade at major investment firms and also help traders replace emotion and guesswork with structure, risk control, and consistency, especially when markets are unclear and pressure is high. By the end of this video, you'll understand the patterns to avoid, the mindset that actually matters, and the opportunities worth paying attention to in 2026. Now, before we talk about opportunities in 2026, you need to know the red flags that will quietly destroy traders in the next year. And we'll talk about 5 big ones today. Red flag number 1, trading news like it's 2020. The year of insane, unpredictable COVID-style volatility is over. And trying to trade the news every single time something comes out will only lead to losses. Even in this era of Trump, where every single tweet seems to be moving the market, you can see that there's always a pattern and predictability, especially if you understand what he's like. Most people either base all of their trades on news events or avoid trading totally when something comes out. For example, one of my students always panicked and got out of trades early when a data or news event came out and price became volatile. And in the beginning, that actually stopped him from getting results. But once he was able to understand the big picture and was able to follow the key trends and what drives the markets, he stopped panicking and started to get real results. Red flag number 2, relying solely on technical indicators. 2026 is a liquidity-driven year, not a pattern-driven one. Candles move because someone with size is making a decision. And if you understand liquidity, you will understand 70% of the market's behavior. Do you know why so many gurus only talk about technical indicators? Because it's the easiest analysis to do. But do you really think prices are just moving because there's some indicator or lines on a chart? That would be delusional, right? There are actually 3 types of market analysis: fundamentals, technicals, and sentiment. And if you only do one type of analysis, it's like sitting on a chair with one leg. You're actually going to get hurt. Now, professionals understand what drives the market, which is fundamentals. They also understand whether investors are in a greedy or panic mode, sentiment analysis. And finally, they use liquidity and professional zones to enter and exit the market accurately to express their views, which is technical analysis. For example, why would somebody short the Japanese yen if they're the only country that is hiking interest rates? It wouldn't make sense. Now, these red flags feel uncomfortably familiar with you. That's usually a sign that your issue isn't a lack of knowledge. It's a lack of structure. We've put together free resources that break down how disciplined traders manage fundamentals, risk, and execution together. And if you want more clarity on trading patterns and psychology that help traders start becoming consistently profitable, check out the free ebook linked in the description below. It's designed to help you map your habits, identify gaps, and start aligning your actions with results. Moving on to red flag number 3, oversized positions to make things faster. Leverage amplifies emotions, but emotions destroy accounts. For example, one of my students, when he first started, he was actually doing very well by following the trading plan and executing systematically. But what he did afterwards is he got overconfident and he started to risk more and more in his account. And he thought to himself, why am I only risking 2% of my account per trade? Why don't I risk 20% and then I can become a millionaire overnight? But what happened when he risked 20% was he shit his pants, because now he's panicking, the numbers are getting bigger, and now his emotions start to run up, and that resulted in big losses, which he now has to recover from. Red flag number 4, chasing hype cycles, especially in crypto. Institutions will very likely front-run the moves, and the retail traders who enter late become liquidity for exits. I've seen countless of times where certain cryptos that are basically dead projects suddenly pump up a few 100%, gets attention, and retail buys in, only for prices to crash 99% and retail traders get wiped out. If you're new to crypto, you should only be looking at the top 100 coins. Understand which projects have real value and which ones are shitcoins. And for proven cryptos like Bitcoin and Ethereum, institutions are now allocating into the markets after regulations have started to become more relaxed in crypto and after the Trump administration have shown support. BlackRock even suggests that everybody should have 2% allocation of crypto at the very least in their portfolio. But right now, institutions have not fully allocated yet because of all of the bureaucracy, right? All of the approvals that they have to get. It takes time for institutions to actually allocate. And what that means is you still have a very small window of opportunity to get in before they do. And the amazing thing about crypto is this is the only asset and the only time where retail investors can actually allocate before institutions. If you think about it, in equities, there's always angel investors, venture capitalists, and then finally the private equity funds, which is why usually stocks after an IPO, they underperform the market over the next 5 years. In real estate, it's the same thing as well. Developers buy the land, right? They develop the building, and then finally they launch the project to retail investors at a premium. And you are the exit liquidity. But the crypto market is different because the main thing that separates crypto is decentralization. And retail traders actually have an edge to get in before the institutions allocate in this specific asset class. But that window is closing fast because institutions are now allocating rapidly. So you got to take advantage of this opportunity, but also you need to know what to do because there's also a lot of scams in the market. Red flag number 5, trading multiple pairs without mastery. More charts doesn't equal more opportunity. It equals more confusion. A lot of people try to monitor 50 different things at once and they get confused, they don't know what they're doing, and they get into random opportunities, which is why they lose money. How professionals understand and analyze the market is first, they understand what are some of the biggest trends that they should be focusing on, and then on a week-by-week, day-to-day basis is to understand where to get in and get out to express the views in those specific assets. They're not going everywhere and trying to look at all of these different things and find different random opportunities, but they're focused on very specific assets that they know have the biggest trends at that particular point in time. So wealth in 2026 is created by process and not by prediction. Everyone wants to guess what's coming, but very few want to build the habits that prepare them for anything. And while it's important to have a general understanding of market signals, strategies, technical analysis, which is somewhat important, this is not enough to be consistently profitable. What really makes a difference is by having a complete trading framework, which includes understanding the market drivers, right, with fundamentals, understanding risk management, having clear execution rules, and also having the psychology and disciplined decision making. These are the things that turn knowledge into consistent results. If you want to see how professionals identify, analyze, and execute in the market, and how we're actually allocating our portfolio, we've linked a free webinar training in the description below. This is the same framework taught at Vincero Investment Academy, where over 4,000 traders worldwide has been trained over it. It walks you through how to trade with clarity, control risk, and make decisions more consistently instead of relying on guesswork. So now that you understand the red flags that will hurt traders in 2026, let's talk about where the real opportunities are, and more importantly, how to approach them without blowing yourself up. The most important premise for 2026 is that money printing has restarted. Most countries are in rate cut mode, meaning liquidity is likely to support the markets in the short term. However, the reason why they're doing that is because economies are actually heading into recession. Employment data is weak, manufacturing data is weak, and some countries are even getting close to stagflation again, which is high inflation but no growth. So what are some of these opportunities? Number 1, crypto. Crypto is no longer for people who want shortcuts. It's for people who want asymmetric opportunity, managed with discipline. Given the last couple of years of development, it is now more structured, more regulated, and more institutionalized as well. Yet many people are still trying to gamble their way in the crypto market. So my 2026 crypto game plan looks like this. While many people discount this, the 4-year crypto halving cycle is still playing out, whether you believe it or not. Since October, crypto has been on a downtrend, just like clockwork. So for now, we need to respect the trend and continue to short the market unless the market tells us otherwise. But the strange thing about this market is there has been no euphoria at all. There's been no extreme hype, and there's been no massive blow off top. But at the same time, we've also not seen a massive drop as well. This means that this cycle is a lot more controlled and institutions are a lot more calculated than retail traders. Given that we have more liquidity and money printing coming in, we may see a cycle extension into the first or even the second quarter of 2026. That is a possible scenario. but I need to see the market cyclicity change into an uptrend to confirm that before I take any action. Remember, the market doesn't care about what you believe and what you predict. You must respect the market movement and take action accordingly, regardless of your own opinions. That is the secret. Opportunity number 2, Forex. Currencies will move less on sudden shocks and more on policy expectations, what central banks intend to do and not what they've already done. Forex volatility won't disappear, but it won't behave like the chaos we saw during the pandemic years either. This means we'll see smaller but cleaner trends and fewer once-in-a-lifetime spikes. There'll be more opportunities for traders with structure, but also punishment for anybody who's trading based on impulse. And that's why my 2026 game plan for Forex is very simple. Number 1, short currencies that are actively cutting rates and continue to do so for the next foreseeable months. Number 2, long currencies that are hiking rates, for example, the Japanese yen, or currencies that have actually finished their rate cut cycle already and are currently stabilizing, like the euro. Then we'll adjust to trade safe haven currencies and safe haven assets as well. Opportunity number 3, gold. Gold will continue to be the emotional asset and the liquidity asset of the world. It'll be moving based on inflation expectations, geopolitical uncertainty, shifts in global risk appetite, and liquidity movements as well. But unlike previous years, I expect gold's movement to be a lot more liquidity driven than fear driven. You cannot trade gold with pure technical analysis. It's going to shake you out 10 times before moving in the actual direction. However, I won't go deep into gold here because it deserves its own breakdown. If you understand why gold matters in 2026, you'll stop trading it emotionally and start using it strategically. I've shared my full gold outlook and positioning framework separately. If gold is something that you trade or plan to, you'll find that linked in the description below. So the key takeaway is this. In 2026, consistent profits won't come from predicting the next big move. They will come from disciplined behavior, understanding fundamentals, and managing risk, and following a proven systematic framework. If this video has added value to you, do check out the free resources that me and my team has prepared. Our ebook and webinar training is linked in the description below, along with the outlook on gold in 2026. They'll give you a roadmap to trade more systematically and confidently as well. And if you want to take your knowledge further and see how the full trading framework is applied step by step, including fundamentals, risk management, and disciplined execution, then check out the free webinar training below. It's a practical walkthrough that shows you how to trade systematically, just like the professional institutions. And if you have any questions about Forex, crypto, or gold trading, leave it in the comment below and my team and I may feature it in our next video. Don't forget to like this video, subscribe, and hit the bell so that you don't miss out on more actionable insights. And I'll see you in the next one.